Hey guys, how are you? I hope all of you are doing really good. So welcome to Economics for Finance Excellency batch. Okay, so what we have been discussing about, so in the last lecture we started with money demand, right? And I told you it's one of the most important chapters, right? In terms that there are certain theories to be covered related to demand of money, right? So in the last lecture, what we discussed was the basics, that what is demand for money, what is the meaning of money, what are the functions of money. So all these things we have discussed in the last lecture. Now, what we are going to discuss is the theories of demand for money. There were various people who looked at the demand for money from the different angles, right? So here we are going to start with the theories now. From here, okay, from here we start with theories of demand for money. Theories of demand for money, right? Now, what are these theories and what is the basics of these theories? So now, first I will just try to create a framework that what theories are all about, right? Just try to understand a little bit of the framework. Now, we say when we talk about money, right? Now he says the money can be kept in two different ways. One is the money can be kept in the way of cash, that is the liquid form, or it can be held in the form of various securities, invested in securities, right? Or I can say the money can be held in the form of investment in securities, or in any kind of investment. Basically you can hold it as FD, right? Fixed deposit, that is one way. So basically the investment part. So money can be held in the form of cash or money can be held in the form of any investment, right sir? Okay, so these are majorly the two parts. Now he says, why do we need money? Why do we demand money? Why do we demand money, right? Basically, there are two major motives for holding the money. One is the transaction motive. One is the transaction motive, that is, you want to buy and sell something, you want to transact in the goods and services. For that, as we discussed in the last lecture also, that you need money, right? Without money, it is not possible because the barter system is not present nowadays, right? So if you want to buy something or if you want to sell something, you will need money for that. So one is the transaction motive. Another motive is that you want to save money for future. You want to save money for future, right? That you want to hold money as cash in the form of, you want to hold it in the form of cash to be saved for any future contingency, that in case in the future if there is any requirement, any medical emergency is there or any kind of emergency is there, then that money that you have saved, it can be used, right? So majorly two motives. One, in one of the theories we will look at another motive there, that is speculative motive. That is speculative motive. What is speculative motive? I'll just give you an overview. Speculative motive says that you hold cash for the purpose of speculation, right? Today you have 1,000 rupees, you want to invest in something, right? Let's say you have 1,000 rupees, you want to invest in the fixed deposit, but today the interest rates are 5% only. Now what will you do? You will hold back cash, right? You will hold back the money in the form of cash and wait for these interest rates to rise. And once the interest rate is 7%, you will invest immediately, right? To gain from that particular transaction. Once the interest rate is 7%, you dissolve your cash money and you put it in the fixed deposit to earn that rate of interest. So you are holding the money for the speculative purpose to earn the profits from there. Clear? So this is another motive, but majorly two motives. One is transaction motive, second is save money for any future contingencies or future emergencies, right? Now, when we say this money invested in the securities, when we talk about this money invested in the securities, two things. One, you are holding the money as cash, right? Another thing is you are investing in the securities. Now, if you are holding the money in the cash, it will have opportunity cost. it will have opportunity cost. What is this opportunity cost? Sir, you are holding 1 lakh rupees in your pocket, right? You have 1 lakh rupees in your pocket now as liquid cash. Now, what you could have done, sir, you could have deposited this 1 lakh rupees in bank and you could have earned interest on this and earned interest on this. Let's say interest of rupees 1000. Clear? You could have deposited this money in the bank and you could have earned an interest of 1000 rupees. Now you are foregoing this 1000. Now you will not be earning this 1000, sir. Right? Now you will not be earning this 1000. Why? Because you have not deposited in the bank or you have not invested. What you are doing is you are keeping it as a liquid money. So this 1000 rupees is your opportunity cost of holding the money in the form of liquid cash. Right? You are not investing it somewhere, you are holding it as a liquid cash. So this is the opportunity cost of holding money as a cash. Clear? So these were the broad things which were required to be understood before we start with the main theories part. What are the various theories of demand for money, right? So let's start with our first theory, that is the quantity theory of money, or it is known as QTM, right? So it is one of the oldest theories of economics, advocated initially by Irving Fisher in 1911, also known as the equation of exchange or the transaction approach. Right? So this theory says you majorly need money for the transaction purposes, right? You majorly need money for the transaction purposes. It shows the strong relation between money and the price level. The theory asserts that the quantity of money is the main determinant of the price level. Okay. Now, sir, what do you mean to say by all these things? What do you mean to say by all these things? Okay, just try to understand this theory. When we are talking about this QTM theory, that is the quantity theory of money. Now, I'll divide this theory. If we talk about QTM, I divide this theory into two parts. One is the demand, and another part of this is supply. Right? One is the demand and another thing is the supply. Now, what is demand, sir? Demand for money. Now, why there is a demand? Let's say you want to buy a particular product whose price in the market, is, let's say, rupees 100, right? You want to buy a particular thing, you want to buy a notebook or you want to buy a special pen or something, whatever it is, right? So you want to buy this particular product, the price is rupees 100. Now what will you do? You will demand 100 rupees from your parents? Obviously, sir. Now let's say in a particular week, you want to buy it 3 times, right? So what will be the number of transactions? In the coming week, you will need it 3 times, right? So the number of transaction is 3. Now, what is the total money that you will demand from your parents? The total money that you will demand is rupees 300, isn't it? Total demand. Sir, you need it 3 times in a week, right? And the price of one time is 100 rupees. So what will be the total money demanded? Total money demanded is the price multiplied by the number of transactions. So this is what is the demand for money. He says, the QTM theory says, Irving Fisher says that the demand for money is dependent upon the price of the product and the number of transactions that you want to do with for that particular product. See here, demand for money is equal to P multiplied by T. What is P? The average price level, and what is T? The total number of transactions. Average price level and the total number of transactions. So demand is dependent upon that. Now, at the same time, now we say we have to equate in an economy, this demand should be equal to supply, right? Now you are demanding 300 rupees. The another thing that you need to see is whether there is a supply of 300 rupees or not. isn't it? There should be a supply also of 300 rupees, only then your demand will be fulfilled, or no? Obviously, sir, right? So what is the supply? Here they have the two variables that Irving Fisher has taken. The one variable is M. M is that the circulation of money, or money in circulation. I'll write it as money in circulation. So M is money in circulation. That how much money is available in the economy, right? Whether it matches the demand or not. So it is money in circulation. Okay, sir, 300 rupees are there in the economy in circulation. The RBI has issued 300 rupees. 300 is the demand, 300 is the money in circulation. But there is one more variable which is important here, that is V. What is V here? V is the velocity of money transactions. Velocity of money transactions. Sir, what is this velocity of money transaction? Velocity means that how quickly the money is moving from one pocket to another, from second pocket to third pocket. Only then, if let's say there is the RBI has 300 rupees in the circulation issued, right? 300 rupees is the money in circulation in the economy, and that 300 rupees reached me, right? So I kept it in the pocket. I don't want to spend it. I don't want to spend it. Now, will this 300 rupees be in the supply? No, sir. That is in my pocket now. That is not in the supply in the economy. Then will this 300 rupees be there for fulfilling the demand of some other person? No, it will not be there because it is not in the supply, right? So V shows us the velocity of the money transaction, shows that how quickly the money is moving from one pocket to another, another to another, another to another, and fulfilling the demand one by one, right? Then, so this is what is given here. The Fisher's equation, MV is equal to PT. This is what? This is your supply. This PT is what? This is your demand. So supply is equal to demand. This was the Fisher's equation, also known as equation of exchange or the transaction approach. So basically, what is the focus here? Here, the Fisher focused on that money is required for transaction purposes. That is why he considered the number of transactions and the price per transaction. Nowhere he considered that you also need money for the store value, right? You need to store that money for the future transaction, for the future contingencies. He didn't take that. Clear? So everything is based on the transaction, and the supply is equal to that also, right? So there was another equation, the Fisher's extended equation. So this M dash and V dash was added. What is that? This is your credit money. This is your credit money. That is, also we can say the money lying in bank. Money lying in bank. This is what? This is your cash money. He says when you are talking about the supply, consider the credit money also, because that is also going into the circulation. You make payments through net banking, you make payments to credit debit card through UPIs. That is what? That is also the credit money which is available with you. That is also the supply, right? So that also has the capability of fulfilling the demand for money. If you want to do 3 transactions of 100 rupees each, 300 rupees, you can do it through UPI if you have money in your bank. Isn't it? So he says even the credit money is to be included in that. So any money which can be used for the transaction purposes. One is the cash money, the liquid cash money. Another is the credit money which is lying in the bank. Clear? So M is the total amount of money in circulation. The transaction velocity of circulation, that is average number of times a unit of money is used in the transaction, right? Some money might be saved by the people. If you have saved that money, you are not spending that money is no more into the supply chain, that money is no more into the circulation part, right? So M dash is the total quantity of credit money and V dash is the velocity of circulation of credit money, right? That how often that credit money is being used for the payments. Now, one line that is written here, that a strong relationship between money and the price level. Obviously, sir, what is that strong relationship? Just try to understand. Sir, let's say the money being supplied, the supply of money is rupees 50 only, right? Whereas the demand is rupees 100. Now what will happen, sir? What will happen? Sir, you will have to reduce your demand according to supply, right? Now you will have to reduce this demand to rupees 50, right? You cannot spend more than 50 because the supply, you have 50 rupees in your pocket, that is the supply, but you are demanding a product worth 100 rupees. Now, can you buy that product worth 100 rupees? No, sir. So you will have to buy a product for 50 rupees. So there will be a time when the manufacturer or the seller will have to reduce the price to 50 rupees. Why? Because the supply is 50 only. He cannot charge more than 50, otherwise the people are not demanding, right? So this will lead to what? This will lead to reduction in the prices. This will lead to reduction in prices, right? That is why there is a direct relationship between money supply and the prices. Try to understand it again, right? He says if there is excess money supply in economy, excess money supply in economy. Now what will happen? If you have lots and lots of money in hand, what will happen, sir? You have your demand will increase, right? With more money in hand, obviously there will be increase in demand. There will be increase in money demand, right? And increase in money demand will lead to increase in expenditure. Now you have more money to do the expenditure, increase in expenditure. That means more and more people are spending on buying the goods and services, and this will lead to what? This will lead to increase in the prices. This will lead to increase in prices because the shopkeeper knows that you have lots and lots of money in the pocket, you are buying things, he will increase the prices. Why not? Right? So more the demand, the prices will increase. More the supply, more will be the demand and the prices will increase. And in this case, the vice versa also holds true, right? If the money supply is reduced, obviously your demand will be reduced. Here, if the money supply is 50 rupees, you cannot demand a product for 100 rupees. You will have to reduce your demand. Yeah, now your demand will be 50 rupees, right? And if you will be demanding less, and okay, then obviously the prices will also be coming down, right? So that is why he says there is a relationship between money and the price level, right? Now, according to Fisher, the changes in the journal level of commodity prices, value, purchasing power are determined by the changes in the quantity of money in circulation. This is what I told you, that the changes in the prices, changes in the demand is due to money supply, that is money in circulation. Higher the number of transactions that people want, higher will be the demand for money. Obviously here if instead of 3 you need to do 5 transactions, your money demand will increase to 500 rupees, right? So more the number of transactions, this price is there, right? The more the number of transactions you want to do, more will be your demand for money, right, sir? Thus there is an aggregate demand for money for the transaction purposes. So that is what the highlight here is, that everything is being done for what? Everything is being done for the transaction purposes. So major part, if we say, of the QTM is focused on the transaction purpose. The Fisher did not specifically mention anything about the money demand. However, the same is embedded in his theory as a dependent variable on the total value of transaction. He says he is not directly talking about demand, but that is embedded in the theory because he says demand for money is equal to P into T. That is the price and the number of transactions that you do. So that is quite obvious that if you want to do 5 transactions or 3 transactions and each transaction is going to cost 100 rupees, that is quite obvious then that you will be demanding 300 or 500 rupees, isn't it? So this was the first theory, that is the QTM theory, quantity theory of money. Now coming to the second theory, that is the neoclassical or the Cambridge theory. Neoclassical or the Cambridge theory with a little bit of a different view. Now this theory says that you need money for the store purposes also, right? Precautionary motive. Along with the transaction motive, there is a precautionary motive also for which you need money. So this neoclassical approach was established in the early 1900s by the Cambridge economist Alfred Marshall, A.C. Pigou, D.H. Robertson and the J.M. Keynes. So all these four were involved in the making of this theory, also known as the cash balance approach. According to this approach, the demand for money is K multiplied by Py. Now what is Py? This Py is the income, right? Py is the income. And what is K? The K is the proportion of income that people want to hold as cash. This is known as Cambridge K because it was the Cambridge theory. So they mentioned this variable as the Cambridge K. He says out of the total income, what part of the income the people want to hold as the cash, liquid cash, right? People need a temporary abode of purchasing power as a hedge against the future uncertainty. That people want to temporarily save some money, hold some money as cash, right? So that they can have it for the future uncertainty. The demand for money also involves a precautionary motive besides the transaction motive in the Cambridge approach. That the Cambridge approach says that it is not only for the transactions that we need money, the money is required for the precautionary motive as well as the transaction motive. So this is what is given by K here, that if you are earning 1 lakh rupees, right, and you want to hold money as cash, that is 50%, right? You want to hold 50,000 rupees as cash. This is your K, that what proportion of the total income you want to hold as cash, right? This 50,000 you want to hold as cash. Now he says in this 50,000, it is not only the transaction motive is there. He says along with the transaction motive, there is the precautionary motive that is also there, because the people want to hold the cash for the future uncertainties also, right? So demand for money depends partly on the income and partly on other factors like the wealth, interest rates, etc. So there are various other factors on which the demand for money depends. One is the income, another one is the wealth, interest rate. What are the interest rates? If the interest rates are very high, right, like the bank says, we will give you 10% interest if you deposit money with us. So the person will say it's better to put more money in the bank to get those interest rates rather than holding money in the cash. That is opportunity cost. If the opportunity cost is too high, then the money holding will be less, or if the opportunity cost is less, then the money holding will be high. Higher the income, the greater the quantity of purchases, and as a result, the greater will be the need for money as a temporary abode of value to overcome the transaction cost. He says if your income increases, let's say your income increases from 1 lakh to 2 lakh rupees, right? At 1 lakh, you were holding 50%. You are holding 50%, that is 50,000 rupees, in which there is transaction motive also and there is precautionary motive also. Let's say you are holding 30,000 for transaction and you are holding 20,000 for the precaution. Now it says if your income increases, your expenditure will also increase, right? Your transactions will increase. Your demand for money will increase. At the same time, you will need more money for the precautionary motive, right? Because to cover up for this transaction cost, that if your transaction cost is increasing, at the same time, you will need now more money for what? For to keep it as a precautionary motive. Now he says out of 2 lakh rupees, you might be needing 60% of it, 1,20,000. Right, and out of this you might be spending 90,000 because your transactions will increase, your demand for the things will increase, and the remaining 30,000 you will put it in the precautionary motive, right? So here there is an increase in the demand for liquid cash from 50 to 60% because your transactions have gone up, and at the same time you need more money for the precautionary motive also, right? So the Cambridge equation is stated as MD is equal to KPY, where MD is the demand for money, K is the proportion of income that people want to hold as the cash balance, right, for the transaction as well as the precautionary motive, and PY is the income. Y is the real national income, P is the average price level of the goods and services, right? So PY is the nominal income. Not to go into the details of that, simply MD is equal to KPY. This PY represents the nominal income, that is the income which you can spend, right? So this is your income level, and out of the income level which you can spend, and this part shows the proportion which you want to hold as the cash balance, right? So this was our second theory, that is the neoclassical or the Cambridge approach, right? Neoclassical or the Cambridge approach. Now, after this, we have one liquidity preference theory, but this we will take up in the next lecture. After this, we have one inventory approach. This we can discuss right now. The liquidity preference theory, that's quite a big theory that was given by Keynes. So we will discuss that in the next lecture. Right now, we'll be focusing on the inventory approach. Now, what is inventory approach? Advocated by Baumol and Tobin, also known as the inventory theoretic approach, right? So as per this theory, the money or the real cash balance was essentially viewed as an inventory which is held for the transaction purposes. So he says, I told you this thing earlier also, he says that the money can be held in two forms. One is the cash. As per the inventory approach, now I'm telling you, they say the money can be held in two forms. One is the cash and another one is the interest bearing financial assets. Another one is the interest bearing financial assets, right? So this is what they say, that the money can be held in two forms. One is the cash form, another one is the interest bearing financial asset. So he says, even if you are, this is what? This is your asset. This is your what? This is inventory. He says, even the cash that you are holding, this is again your inventory, right? Now this theory says you have to manage your inventory very smartly. Why? Why you have to manage your inventory very smartly, sir? Why there is a need to manage this inventory smartly? Because holding the cash has what? It has opportunity cost. It has opportunity cost. Opportunity cost, as I explained to you, that if you are going to hold more of cash, then you will be losing out on the interest that you could have earned by investing that money. That is an opportunity cost, interest lost. Interest loss, because the money itself, if the money is lying in your pocket, is it going to give some return? No, sir, it is not going to give some return, right? If you have 10,000 in the pocket, they are going to remain 10,000 only. Your pocket is not going to pay any interest to you, isn't it? So that is what he's saying, that if you are holding the money as cash, that is again an inventory, right? You can hold money in cash or in the form of bonds or interest bearing any financial asset. In case you hold it as a cash, there is an opportunity cost, so you have to be very careful. Carefully manage the things, right? So whatever the money that you require, hold that much only in the cash, deposit or invest the rest in the bonds or any financial assets from where you can earn interest, right? So it says there are two ways of storing the value. One is the money, that is the cash form, and another one is the interest bearing financial assets, right, sir? Like businesses, the individuals hold cash balances for the day-to-day transactions. Obviously, he says, why do we need cash? We need cash for our day-to-day transactions, right? We need cash for day-to-day transactions. This involves an opportunity cost in the form of foregone interest. That is what I explained to you. If you are holding the cash, then you have an opportunity cost in the form of interest foregone. Individuals therefore hold the optimum combination of bonds and cash balance so as to minimize the opportunity cost. That is what they say, the individuals need to smartly balance between what is to be held purely as a cash and what is to be held in the form of interest bearing financial assets, so that the total opportunity cost is the minimal. He says the receipt of income takes place once while the expenditure is spread over a time, say a year. Hence, the individuals hold cash for carrying out their daily transactions. What does it mean? That, sir, you are getting a salary on the 1st of a month. Let's say on 1st of March, you get your salary. You get your salary of 50,000 rupees. Now, will you spend this 50,000, the whole of 50,000 on one day itself? No, sir. The expenditure will continue over the next, right? This is where the expenditure will take place over the next few days or the whole month. There will be expenditure. So for this whole period, you need to hold money. right? You need to hold money as cash because receipt is on a particular day, whereas the expenditure is spread over a particular period, right? For the future, this is your future, right? So you need to hold cash also, but the excess cash, if you have excess cash, you can deposit that, right? The excess cash over what is required for carrying out transactions will be invested in the bonds or any interest bearing instruments, right? So out of 50,000, if your monthly expenditure is, let's say, 30,000 after all the things, so you have 20,000 rupees extra, right? So this extra you will invest. This extra money you are going to invest, right? Now he says, what are the various factors determining the demand for money? One is income levels. Higher the income levels, more will be the demand for money. Obviously, sir, higher the income, higher is the amount of expenditure requiring the higher level of money holdings, right? Higher the income, higher you want to buy the expensive things. You want to buy more and more of things because you have more money in hand. So your demand for money holding in the form of cash will increase, right? You will invest less, you will hold more because you want to do the expenditure part. Then is the number of transfers. Average transaction balance of the money holding is a function of the number of times the transfer between. Now, what is the average balance of money holding means that how much on an average you are holding the money. If you are doing too much transactions between the money and the bonds, you are transferring too much, then on an average the balance will be low, right? Higher the number of transfers, the lesser will be the average transaction balance holding. Third is the transfer cost. Once you transfer the money from to bonds, right? What you are doing, you are making an investment. Now this investment will include the transfer cost, right? Transfer cost means the cost of brokerage is there. Every time you want to invest the money in the bonds, you will have to incur the brokerage cost, or every time you need to convert the bonds into money, again you will have to pay the brokerage cost. So all this is what? Transfer cost. If the transfer cost is high, your number of transactions will reduce, right? This refers to the fixed cost per transfer. For example, brokerage, bank charges, etc. An increase in the transfer cost raises the marginal cost of bond transaction and consequently lowers the number of such transactions. So the lower number of transaction will help in identifying the average balance for money holding, right? The individuals would hold the cash as well as bonds in his portfolio in such a proportion that his cost is minimized. Which cost? This opportunity cost. What is the purpose? You have to minimize this opportunity cost. You have to minimize this opportunity cost, right? So this was our another theory, that is the inventory approach. Now in the next lecture we will discuss about this particular approach, liquidity preference theory by Keynes, which is very important, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.